What's up, world? Welcome back to another episode of the MITM podcast, where we unlock success daily by journeying through the 6 pillars. I'm your host, Ty Aarons, and today we're venturing into the realms of financial well-being by discussing the importance of diversifying your investment portfolio for long-term growth. That being said, run the intro.
Caught up in them bright lights, lusting for shiny things that's golden. Everything ain't always what it seems, let it soak in. Chasing my dreams, coming apart at my seams. Best believe that the money is the motive. All
right. Welcome back to another episode of the MITM Club podcast. A well-diversified investment portfolio is key to achieving long-term financial goals and withstanding market fluctuations. By spreading your investments across various asset classes, you could potentially increase your returns and mitigate risks. So let's delve into some tangible tips to help you diversify your investment portfolio for long-term growth. Into tip number 1, understand asset classes. Start by understanding the different asset classes, that are available for you. These include stocks, bonds, real estate, commodities, and cash or cash equivalents. Each asset class carries its own risk and return profile. Educate yourself on these to make informed decisions about how to allocate your investments. Sometimes it's important to sit in cash because the world is about to burn down, and when it rains, it pours. So while everyone else is stressing out financially, that's the time to buy. So holding on to some cash may be important so you can acquire other assets. And that's just like one example. We'll go deeper into asset classes another day on the podcast. Tip number 2, allocate across the asset classes. Allocate your investments across various asset classes to spread the risk. Different asset classes perform differently under varying economic conditions. When one performs poorly, others might do well. This diversification helps balance your portfolio and reduce the overall risk. Tip number 3, consider risk tolerance and time horizon. Take into account your risk tolerance and the time horizon. Assess how much risk you're comfortable with and how long you plan to invest. Younger investors with a longer time horizons can usually afford to take more risk, potentially aiming for higher returns. Compared to older folks, like the difference between retiring in 20 years and 5 years are two very different worlds. Your risk tolerance is going to be very low if you're trying to retire in 5 years because you don't have time to make that money back or to correct course if you lose it all. Compared to if you're young in your 20s, you have 20 or 40 years before retirement, before generally people retire, you have a little bit more space to make those mistakes. Although if you're listening to this podcast, you shouldn't be making mistakes, all right? We're going to guide you through everything. Tip number 4, opt for mutual funds or ETFs. Consider investing in mutual funds and exchange-traded funds. These offer diversification within a single investment. These funds pool money from multiple investors and invest in a diversified portfolio of stocks, bonds, or other assets. This provides an easy way to diversify your investments. In fact, this is how I started off. When I was younger, I was investing in mutual funds, and I was getting a 14% return per year, which was really good, really good. I watched my money go from 5,000 to 10,000, 10,000 to 20,000, and it was great. Tip number 5, rebalance your portfolio regularly. You want to review and rebalance your portfolio on a regular basis because market fluctuations can cause the asset allocation to drift from your initial plan. Rebalancing ensures your portfolio stays in line with your risk tolerance and long-term goals by adjusting the allocation back to your intended percentages. Tip number 6, seek professional advice. Consult with a financial advisor for personalized guidance. A financial advisor can help tailor your investment strategies to your financial goals and risk tolerance. They can assist in creating diversified portfolios that align with your long-term objectives. So taking the financial base camp challenge, which will align you with a financial professional, is one of the best steps and best tips that you can take. The system's already done for you. Okay, you don't have to think much at all. Okay, in less than 10 minutes a day, you can go from financial failure to financial success. Okay, with the Financial Basecamp Challenge, you'll avoid the valleys of financial failure and get closer to the peaks that you would like. Now that concludes today's episode of the MITM podcast. Remember, diversifying your investment portfolio is a fundamental strategy for achieving long-term growth and financial stability. Understand asset classes, allocate wisely, consider your risk tolerance and time horizon, opt for mutual funds or ETFs, rebalance regularly, and seek professional advice. Join me next time as we continue exploring matters that shape our lives. Until then, may your investments flourish and your financial future be bright. I'll see you tomorrow. Peace.
Give them that creme de la creme whenever I spit that hot shit. Ain't no lose or draw when it's the only option. Till I'm balling like Stockton, I'm locked in. Researching the best stock tips, fuck gossip unless it makes a profit.